to Jay. So he's going to talk really about the results. But to begin with, all this really kind of started when we met with some stocker yearling producers in Nebraska and asked them about issues or things that they wanted us to address. And one of the things that came up quite consistently was questions about the optimal rate of gain in the winter, as well as timing of marketing. And in particular, the timing of marketing that kept coming up, especially for our Sandhills yearling producers, was marketing in July versus September. So we really set up a analysis where we were looking at two different rates of gain, basically kind of a fast winter rate of gain versus a slow winter rate of gain, and then did a 2x2 factorial, which basically means we compared calves on this fast winter rate of gain. What if we marketed them in July or if we marketed them in September, and then the same thing for the slow winter rate of gain. And before we get to what we found, I kind of want to explain a few things in terms of our assumptions and how we went about this so that you can really think about it in comparison, to your operation, and make sure that that really, where things might align and where things may differ from what you're doing. If you have questions during the presentation, you can put them in the chat and Casey can stop us and ask those questions, or you can just unmute and ask your question. We don't have to be super formal here. So just to kind of lay out the yearling systems that we were really looking at, we basically assumed you were going to have calves in October, either that, were from your own herd and you decided you're going to keep them and put them into a yearling system, or maybe you're going to buy calves. So we looked at October. You're going to have these calves, you're going to process them, you're going to put them in the dry lot or feed them for a couple weeks, kind of get them settled down, straightened out, and then you're going to take them and put them out onto corn residue is kind of the system that we modeled. And when you put them on corn residue, we said, all right, we're going to feed them distillers grains, either for a fast winter rate of gain, and in this case, we were shooting for about 2 pounds a day, or a slow winter rate of gain. And in this case, we're shooting for about 0.8 pounds per day. Then we could either sell them in February when they came off stocks, or we could keep them and feed them through the spring and get them out onto summer grass. So feeding them in the spring, really what we looked at was feeding them some hay and feeding about 2 pounds of distillers for really a moderately low rate of gain, about 1 pound a day rate of gain. And then you put them out on grass, and either you sell them in July or you sell them in September. So we kind of looked at these different scenarios, and that was kind of how we went about looking at what options might be best for some of our producers. And the way we did it was we really went back and we looked at what did the previous years tell us about the responses that we would see based off of marketing these cattle at different time and the feed costs that would have went into them for each year. So really we're looking at an individual year, what if we had bought the feed and fed them, or charged the grass to them, and then if we had marketed them at these different times, what would happen. Before we get to that, though, I want to show you a little bit about how we got to the rate of gains and the responses we expected. So this is actually from a trial where they looked at having a slower rate of gain in the winter or a faster rate of gain in the winter. So this is basically, these rates of gains are what we modeled. And then this is the performance of those calves when they went out onto grass in the summer. And so first thing you probably notice is that if they had a slow winter rate of gain, the rate of gain, say for the July calves on a slow versus the July calves on a fast, is much greater. Well, that's what we would expect, because we would expect that if they had a slower winter rate of gain, they would compensate in the summer. And so that's reason why a lot of the producers were asking that question. Should they be targeting a slower rate to get that compensation in the summer and get a greater rate of gain in the summer, with this idea that it's the same grass cost? And so I put less supplement into them in the winter, but then I get it back in the summer, was kind of the thought process. The other thing you might notice is that the rate of gain between the July and the September, it's higher for the July calves than the September calves. And that's because if we look at the grass quality in the summer, it's greater earlier on in the summer, and so we have higher rates of gain. And as we keep them later, we actually start seeing the rates of gain decline. And so that's another reason why this idea of should I be selling them earlier pops up, is because you're getting a higher rate of gain in July. So bottom line is, we use these rates of gain in the summer to model our system. So this is based off of actual results of putting calves out onto the grass and the sand hills, and that's the responses that were observed. And so that's kind of how we modeled our systems. Now, to achieve the slow rate of gain in the winter, basically we modeled corn residue with 1.3 pound a day of supplement of distiller's grain. And for the fast rate of gain, we modeled 7 pounds a day of distiller's grains. And basically that was also based off of some data. This is a pooled analysis of several studies where they fed distiller's grains on corn residue. And we can pretty much predict anywhere in between in terms of the rates of gain. I will tell you that 7 pounds is basically here on this model. So we're kind of at the extreme end of the rate of gain we have achieved or even targeted with calves on corn residue or stalks. Okay, so let's look at the winter costs real quick and some of the assumptions we made. So we modeled these systems from 1999 to 2017. And there are some things that we held constant across years, and there are some things we varied with the market. Feed costs, we varied based off of marketing data in Nebraska, and of course, calf value, we varied according to the marketing data. But some things held constant, like we charged $15 for processing those calves. We charged actually for receiving and keeping those calves for 14 days before we put them out on the stocks, and that charge we just held constant. So interest on the animals, so basically if you were to buy animals, or if you weren't to, let's say, pay off your loan because you kept those animals, you would have to be paying in some interest on that loan, and so we charged for that. We also charged for death loss, and again, both of these are tied to the market value of the calf. So you can see there's a range, and that range just really represents the range across the years. This is the lowest cost. This was the highest cost across all years. And these parentheses is the mean. So that's kind of the average across all the years. A couple other things I really wanted to point out. We charged 56 cents per head per day for grazing those calves on corn residue. And you can see that the fast and the slow, we charged the same amount. Now, some could argue that those that were getting basically 1% of body weight of supplement are not going to eat as much stalks. And so we could have had a higher stocking rate and charged ourselves less. But the data that we used to predict their performance was using the same stocking rates across the different supplementation levels. So we kept that constant. Excuse me. You see distillers, of course, is the one big thing that varied between the fast and the slow. And so here, I wanted to point out that distillers' cost, of course, across from 99 to 2017 varied quite a lot. And early on, it was a lot cheaper than it was later in the later years. So it varied from $71 a ton to $282 a ton. Most people are probably looking at this thinking $282 a ton is about what it is right now. It is getting fairly expensive. And so the range in cost there was $31 to $125 for the fast. And of course, it's much less for the slow because we're feeding less, of $6 to $23. On average, the difference in cost was about $50, and the maximum difference in cost was about $100 per calf um, over the winter period. So we charged for mineral, and we charged 5 cents per head per day, which they're eating 4 ounces is equivalent to about a $400 a ton mineral. So, you could up that if your mineral's more expensive, or if you don't feed mineral, of course you could take that out. But we did charge something there. Again, interest on feed. Total wintering costs, 200 on average dollars for the fast and 153 for the slow. Again, that difference in cost is $50 between the fast and the slow on average. And then the greatest difference was $100. So if you look at this, I think the most important thing to understand is that there's other costs associated with having those calves beyond the supplement. And so if you think about how much cost the supplement actually is adding, it's a small proportion. It's about a fourth of the cost on the fast. And so we're distributing more pounds over those costs and more pounds of gain. And so I think sometimes we kind of forget about that when we look at that feed bill. Okay, so one other big assumption that I wanted to point out, because it's something that I think is important, is that calves, when they're undergoing compensatory gain, they actually increase their intake on a percent of body weight relative to calves who are not undergoing compensatory gain, such that basically they have a similar dry matter intake. So this is some data where they had calves that in the winter, they had them gaining basically 1.5 pound a day versus a half a pound a day. And in the summer, when they went out on grass, the calves who were gaining more did not gain more in the winter, did not gain more in the summer, right? The calves who were gaining less in the winter compensated, they gained a little bit more in the summer. Typical response we would expect. But what most people don't recognize is that some of the reason why they're gaining more is because they're eating more on a percentage of body weight basis. So if we look at these two here for their summer intakes on a percentage of body weight basis, you can see those calves who are lighter weight gaining more, they were eating a higher percentage of body weight. And on average, they're eating about the same amount of dry matter. So if you had your own grass and you were going to put calves out there, that calf that's bigger coming out of the winter because it had a higher rate of gain is basically eating the same amount as that smaller calf coming out of the winter. And so your grass price or your charge should be similar because your stocking rates should be similar. However, you got to recognize that if you're renting grass and you're renting on an AUM basis, that landlord may charge you more for that 750 pound calf than that 600 pound calf. That's not the assumption we made in this trial. We made the assumption that they're eating the same, and so we're going to charge the same. This is just another trial that showed the same thing. They basically had very similar rates of gain. Again, winter 1.5 versus half a pound a day. And then they either put them on cool season or warm season. It didn't matter. You got the same response. The lower winter rate of gain compensated by eating more on a percentage of body weight basis, such that they eat the same amount of dry matter intake. So that is the assumptions that we made. Okay, so the other thing I wanted to point out was just really the variation in grass price. So we based the grass price on the rental rate data that Jim Jansen has published over the past few years. And then, of course, before him, I think Roger was the one who was doing it, Roger Wilson. But we have historical data on what the rental rates are, and what we did here, as you can see, in 2000, which of course, if you bought a calf in 99 or you kept a calf in the October of 99, you'd be grazing in 2000, the summer of 2000. You can see that it ranged from about $40 per head, 40 cents per head per day in the early years, and then it elevated and significantly elevated, right? From basically 2013 up to about 2015, up to about 107, if I remember correctly, in 2015. And we've declined a little bit, but the major point here is that there's a whole lot more cost going in these later years and these early years. But as you will see, that really did not make a big difference on the responses we observed, because you have your grass prices, and you have, of course, those market data, and it does not seem to make a huge difference in our responses relative to each other, if that makes sense. Okay, last little bit here I wanted to go over was looking at the spring and summer cost assumptions. And, we basically wintered those calves on stocks for 127 days. And then I said in mid-February, we were going to have to pull them off, which is pretty typical. And we were going to feed them some hay and some distillers. Again, because of the dry matter intake data that I showed you before, we assumed the same dry matter intake regardless of fast or slow. And, of course, July or September doesn't matter right now, because that's all about when we market them. So we have that rate being the same for the spring on average across all of the models. We did charge for spring yardage at 25 cents per day. And then the difference really comes down to, if I market in July, I'm only grazing on summer grass for 62 days, versus if I was grazing through till September, I was doing 120 days. So basically the difference between July and September on average was about $40 per calf, more if I went all the way to September. And so what I really wanted to show you here is that was the big difference. We, again, charged interest on feed and the animal costs, interest on the animals. So if we look down here at total costs, that's winter, spring, and summer. The difference in our systems, remember, was $50 on average for our distillers between the fast and the slow. So if I look at fast July versus slow July, you see basically they're $50 difference. If we looked at July versus September within the same realm, right, it's $40 difference. So fast July versus fast September is 40. So if you look at the two extremes, on average, the big difference was $100 difference in cost. If I went July slow, that was the lowest cost system. I had least amount of distillers in them, and I had the least amount of carrying them through on grass. And so I had basically $100 cheaper than the most expensive system, which was feeding them more distillers in the winter and keeping them longer into September. So now Jay's going to show you about what the predicted profits would be on those systems.
Thanks, Mary. I'll go ahead and share my screen. Well, that's coming up. I want to clarify, you've probably guessed by now, but these are actual prices that we used. And of course, 18 years is a long time, but just so everybody's aware.
Bottom drawer. No, bottom drawer. Bottom drawer.
That's not me. Just so everybody knows, we did not adjust for inflation on these things. So that upward trend that Mary was showing you on the grass price, had that on that. But it also pertains to the volatility that you'll see. And this is the actual profits as they come out. This is the whole ball of wax. So when Mary said I'm going to show the results, I'll just show this and then everybody can figure it out, right? But it looks pretty ugly to start with, but this volatility that we're seeing here in the last part of that, of course, has to do with all the stuff that was going on in the marketplace, in 13, 14, 15, when we had the big run up in prices and then the drop in prices and so on happening. But those are actual prices that we're using in there. So that's exaggerated a little bit in that sense that we didn't deflate those back to the earlier years, or we didn't inflate the earlier prices and whatnot. So everything in here is actual prices. Now, this is busy to look at. obviously, but we have all of the different scenarios in here, and the grass scenarios are the 4 on the right here, but I'd like to focus first on that February time period, because that's if the February fast would be if you're feeding the extra distiller's grains and getting the extra weight gain. February slow here in the gray would be if you're not. And you can see those two just tracking along here pretty much together with each other, you know, hugging there right around the break-even point. Sometimes you make money, sometimes you don't. But of course, that's the shortest time frame that you can actually own the animals. So there's less profit potential there in that over those 18 years. Probably the biggest thing that stands out, if you look at those two lines as they go across, is you always see the orange above the gray. So if you're looking at a situation where you think you might want to sell these animals in February, one thing that jumps out at you is it makes sense to feed the extra distillers grains and put extra weight on them. Matter of fact, every single year through this time frame, that was the right choice if you were going to sell in February. So that's one take-home point just from looking at some comparisons. The others are not quite so clear, but we'll just look at colors here on this, and then we'll kind of break it down in the next few slides here as far as pairwise comparisons and then just different decision points. But one thing you might notice here is the green line tends to kind of trail on top of things here. Okay, it kind of caps everything off here. As you look through, it's not always the best, but it's usually up towards the top. And that's if you are feeding that extra distillers grains to the fast winter growth diet and you hold them through September. So one of the themes that comes out on this is, you know, carrying them through September increases that profit per head potential that you have on those. Now, it also introduces some risk in terms of the downside also being a little bit more pronounced if you carry them through that. So if you make the decision to feed them the heavier diet in the spring or in the winter, it makes sense to look at carrying them on through September. The other things are not quite so clear, so we're going to break those down here by looking at some other numbers and coming back to this graph a little bit later. Okay, so this is the profitability comparison just in numbers. Now, there are 18 years involved in our data, okay? And as I said, those selling in February wasn't just a slam dunk that you're going to always make money. As a matter of fact, if you fed them the slow growth diet with lighter amounts of distillers, only about 1/3 of the time did you actually make money on them. With the data that we have. It's a little bit more of a 50-50 deal. A little bit over 50% of the time you made money if you fed them more distillers and put more weight on them. On average, you know, you made about $70 more with the heavier diet on a per head basis. These are all dollars per head that we're looking at here. Much more on the upside and a little less on the downside. So it's pretty much a slam dunk, like I said, if you're going to feed them. Look at February sales potential of get rid of them in February. You definitely want to pour some distillers to them and put on more weight. If we go on then and look at some of the other comparisons, the September fast diet down here, that's where we saw on average, remember that's the green line that was up on top in our graph that looked like it was a little bit more potential, okay, as far as having profits attached to it. If we look at that, we see about a $20 on average benefit, right, to carrying those animals that had the extra distillers put to them. Go ahead and carry those through to September, about a $20 per head potential profit gain there on average, okay. It also contained more risk, and that's in a couple of areas. One of them is there's one more chance out of the years that they lost money. So there's only 2 years that you didn't make money on selling them in July, but there was 3 years. There's another year where you lost money basically by holding them till September. And then if you look over here on the spread, there's a bigger spread by holding them through September. Okay, so as we compare these, you know, we look at it and we say, okay, so there's more risk and there's more reward that makes sense, right? That pretty much holds true most of the time when you're looking at retaining animals. On the slow growth side, though, if you did feed the slow growth diet, of course, you wouldn't be targeting a February sales date. You'd be looking at either July or September. And there, it's just the opposite situation. Okay. In that case, you actually make more money on average if you go ahead and sell them in July. Okay. And there's a number of reasons for that. The big one being the price slide. And whereas the July, if the fast diet is in place, when they hit July, they're already pretty heavyweight animals. They don't gain a lot of weight between July and September at that weight, but they're pretty much in the same price bracket. And we used prices from the Livestock Marketing Information Center, and basically auction data, average auction data here in Nebraska for that, for the different price categories. And we use the 50-pound increment data that they had available. So basically, because those cattle were lighter in July and they basically crossed over from about a low 900-pound animal up to about 1,000-pound animal in the assumptions that we had working here as far as what they came out at, there's a significant price slide involved there with that. So that explains a lot of this difference in terms of the average value of net profit that you get there. A little bit more mixed over here. This one is a lot more stable. Okay. So we'd look at this, whereas before you'd say, well, I took on more risk or got more reward here. I probably took on more risk. It's not true. Okay, in this case with the slow growth diet, you actually get more stable returns by selling them in July, and you make more money. Okay, so whereas the fast growth diet, keeping them, get more returns, but you got to take more risk. Slow growth diet, it's pretty much a slam dunk that if you do the slow growth, you're targeting July sales, at least with the options that we had available here. And you can see also that you're more likely more often going to lose money or not as often make money if you carry those over through September. Okay, so why is that? What does that price slide look like? Well, for the fast growth, they're still pretty heavy there for July sales date. We were projecting just over 1,000 pounds. In September, you know, they're only putting on 66 pounds here, but we looked at the price data, the average price data for 1,000 to 1,050 pound in July versus what we were looking at in September. Not a lot of difference there. So they're holding their value on a per pound basis on average year to year. And there's some outliers to that, of course, what we saw with the markets when they dropped from their highs back in 14. But anyway, so that's a big deal there, that cost of gain and this market price are basically fairly comparable just because we're holding a pretty good value there. On the other hand, if we're going from the low 9 weight up to 1,000 pounds for those slow growth animals, then we got to deal with almost a $10 a hundred weight or dollar pound price slide with those. And that's what makes that going to September not a really good idea. You're much better off, much better returns and much more stable returns if you go ahead and sell those animals in July. So those are big take-home points. This is the price data, okay? And I mentioned the market stuff, and so this is kind of interesting to look at and just break down. And these are all the prices involved, including that October purchase price, which is in the light blue here. Okay, and we expect that price for that calf coming in. These were 570-pound calves, if I recall correctly, in October. And of course, that's the highest price that we could pay. And what we see here is in 2014, we actually have pretty high prices. That's where the prices were up at their highest. And then, of course, they dropped from there pretty quickly. So they climbed and then they dropped, and we had all that volatility happening there. Some things are a little counterintuitive, perhaps. And one of them is that we say, well, this here is our high prices. That must be where we made the most money. And that, in fact, is not true. Because if we go back to this graph, it's actually the previous year where we make the most money. Okay. Now, why is that? It's not that we had high prices. It's not where the prices are at when you enter into the system. It's where they're headed. Okay. And so in this case right here, we have a good high price. But if we look at the gap, if you just draw a vertical line through here, okay, you see what happens to the prices as we go through the production cycle here, or the production year. So this is October wean calves, about 570 pounders. If we go through the slow growth, they only put on about 100 pounds. And in February, we still have a pretty big price drop there. And then we have another price drop down to the heavier animals, okay, that are putting on about another 150 pounds because we fed them more distillers. Okay, and so that's basically we're losing value, a significant amount of value per pound. So even though we have some weight gain going on there, it's tough to make money off of those. If we go on into July, we hit the next ones. The slow growth is very close there, but if you look at this gap this would be from February price on into July for those same calves on that slow path. Again, a pretty significant drop there. Not quite as big of a drop if we look at the high growth ones from February into July. And then finally, if we go into the September category, they're both in that heaviest weight category there. And we have yet another drop down here. So as it goes through the year, these prices are dropping. And then, of course, that's reflected the next year with lower prices. And so no surprise then when we look at the profits for 2014, they're mixed. And the longer we keep those animals, right? So as we go into the later time period, so this would be selling in July. These guys down here would be selling in September. If we keep them longer, we lose money. And then at that lower price level in the following year, we lose money all across the board. Okay. And again, not a surprise, because if you look at what happens in the price ranges here, we still have a drop throughout the year, very similar relationship, but it's all at a lower price level. So why do we make money back in 2013? Well, that's where we're seeing the price climb. So if we look back in 2013, the prices that we're buying those calves in or pricing those calves in October is right in the middle of the range. Okay, if we put them on the heavy growth diet, a little bit of drop there in value as far as price per pound, but everything else is up quite a bit. So we're buying them in here and we're bringing them out at heavier weights at higher prices. And so that's reflected by these really good values up here, these good returns, right, that we see for pretty much everything but selling in February. Okay, so it's very important to look at what's happening in the marketplace in terms of within the production year, not just the level of prices that you're at overall in that year, but how does it change from one period to the next versus the weight that you're putting on. And we'll come back to that here in a moment. But some quick take-home points that are just slam dunks. Can't emphasize this enough. If you're going to go through the winter and you're deciding you might sell in February, or at least that's a strong possibility that you might decide to do that, it makes perfect sense to go ahead and feed the extra distillers. It always comes out a winner compared to feeding the slow growth diet. And if you do decide to feed the slow growth diet, there's an incentive to keep them on into the summer. Okay. So let's just say, let's start with the premise here that you fed the fast growth diet in the winter. Do you sell in July or do you sell in September? Okay, and this is taking all the different profit possibilities and throwing them into bins. So the dark lines are where the profit per head went for selling in July. The striped lines are where they are for selling in September. First thing that jumps out at you is this tall dark line right here. This is $0 to $100 per head in profit. And so if we sold in July about half the time, that's where our profits lie. $0 to $100 a head. And you say, well, that's not bad. I'm making money there. But as we move to the right here, we see that a lot more of the September profits lie up here in the $100 to $200 range. Okay, which is better. More is better. So in general, we see more upside to the striped lines. Okay, so more profit potential by holding those to September. On the flip side of that, there's 3 years where we lose money versus 2 years on the if we sold in July. So again, this is another way of looking at that picture of more reward for holding them to September, but we also take on more risk because the striped lines are more flatly distributed. The dark lines are more bunched right there in the middle, and then we have some outliers on the outside. Okay, so that's that July fast versus September fast. Okay, some reward with a little more risk. July slow versus September slow. we'd expect it to flip around on us a little bit, and it does. We still have this spike here in the middle. Okay, but we also have some July sales that are pretty strong and competitive here in the $100 to $200 per head range. And a matter of fact, over here in the $300 range. So we have a lot more black going out here to the right. So July looks a lot better in this scenario here when we compare it to the September. And if we look at the bottom end, we actually have 5 different scenarios where September loses money and only 2 where July loses money. So in this case, we'd argue that July is a lot more tightly bunched, less risk, and actually quite a bit more reward on it. Okay, so that's one of the ways that we look at that, and a number of different things, and just in terms of looking at the volatility as we go through here and compare the different prices through time. So that's it in a nutshell in terms of just the price volatility, and look at those raw numbers. Now, the last thing I want to look at is just this incentive to carry it through the different phases. And so Mary had this up. I modified this a little bit in terms of how the systems are set up to leave room to put in these cost of gains and the values of gains. Because you know, that cost of gain is something we always are pretty aware of. What does it cost? What am I putting into these animals, and what are they putting on for weight? And then how does that cost of gain work out? And value of gain is a really important piece in any time that you're dealing with a growing animal, because it takes into account changes in market value and market price in particular. So if you lots of producers, I shouldn't say lots of producers, some producers make the mistake of comparing their cost of gain to the actual market price they expect to receive. And it's not a fair comparison, because you got a beginning value to that animal, and value of gain takes that into account. The way you calculate value of gain is you simply say, what was the animal worth when I started feeding it versus what is it worth at the end of time when I'm done feeding it. So if it puts on $250 worth of value, okay, and then what did it cost me to actually do that? Okay, so how much weight is there involved with that gain? So let's just say you put on $250 worth of value and put on 250 pounds. That's the value of gain of basically $1. Okay, and that would be compared to your cost of gain. So when you do that on this, and you look at, for example, the fast winter diet, whether you sell in February, you sell in July, or you sell in September, all the way through those phases, you can see your cost of gain. You start off at about a 79 cents a pound cost of gain through the winter, 67 cents in that February to July period, and then 69 cents in July to September. Very consistent throughout. The value of gain, these are averages, by the way, of all 18 years. The value of gain is also very consistent, about a 96-cent value of gain in the first phase from October through February, and then $1.01 from February through July, and then from July to September, $1. Very consistent there with that. Little lower margin here in the winter, 17 cents a pound, and then 33 cents and 30 cents respectively for the other 2 periods. Okay, so that's a fast winter gain. If we look at the slow winter gain path, okay, it doesn't look so good through the winter, which is not surprising, because we already kind of eliminated that as sell February is not a good idea, and this explains why it's not a good idea. Cost of gain is really high. They don't put on much weight. So much of that is tied up into your fixed cost, as Mary said in the earlier slide she had. There's a $50 difference, but there's $150 that's not different between them, right? So you end up with a really high cost of gain at 152. Value of gain is also pretty high, but net is a pretty significant loss there per pound. If you keep those through July, you get that benefit when they go out to grass, okay, of that compensatory gain. So while your value of gain holds strong at $1.04 still here, very comparable to what it is, okay, up above in the fast growth diet for that same time period. But look at that cost of gain. It goes down quite a bit, 51 cents versus 67 cents. So your profit margin is higher here in this. That's the compensatory gain effect. So bottom line, if you're going to go the slow route through the winter, you definitely want to capture this benefit by keeping them through to July. but it's because of the price slide, it's not a good idea to keep them through to September. So we see the cost of gain here, 50 cents, very comparable, just like it was up here, very comparable. But because of that price slide, the value of gain takes a big hit here. And on average, we lose money in terms of the value per pound. So if we eliminate everything but those things that seem reasonable, which would be, say, sell in July, sell in September after fast winter gain, or sell in July after slow winter gain, and just look at those on a cumulative basis, they turn out to be very comparable, okay? Fast winter gain, if you sold in July for that whole period from October to July, your value of gain would be 99 cents, cost of gain 74 cents. So you get 25 cents margin per pound gained from October through July. If you held those through September, value of gain is flat on. This is, again, averages over the 18 years, 99 cents. Cost of gain is 73 cents, virtually identical results in terms of that margin. But keep in mind, these are about 70 pounds heavier here. So you take a quarter, roughly a quarter of those 70 pounds, and that's where you get that $20 difference in average profit. Slow gain in the winter, sell in July. What does that look like? Well, surprisingly, that looks very much like these guys, actually a little bit better in terms of that margin. You got a higher value of gain, very similar cost of gain. It's a little bit higher, but the difference is a 33-cent margin versus about a quarter. But keep in mind, these animals here are roughly 100 pounds lighter than these animals here. Okay, so this margin is per pound, and you're getting about 100 pounds less in July. So that's so July does come out ahead. If you remember right, there was a $5 difference per head in average net value here versus here. So it's not quite as, and again, this is cents per pound, but that is made up a little bit just in the fact that you have lighter calves. Okay, so, all right, we've got to wrap up here. Summary, what we found out as we looked through them, again, just to reiterate, February sales, that's on your decision tree. There's a good possibility. Feed them heavier in the winter, okay? If you're looking at September, wanting to keep them through to September, same thing. Feed them heavier during the winter. That opens up that possibility. If you're set on targeting July sales, then slow growth through the winter might make sense, okay? And it makes sense because it gives you slightly better returns, and it also presents slightly less risk, especially in a declining market, right? Like we saw there in 14 and 15, as we went through a period there where prices were just kept dropping and dropping. So you're not subject to that extra market risk going from July into September. And if you'd like to target that July period, then go for it with the slow growth diet. But realize that the fast growth winter diet does provide the flexibility, if you want to use it, to bail out in February or to extend to September, as far as having a decent outcome in any given year. So that's kind of the summary as we go through it. I don't know if that brings up a lot of questions. One of the things to consider here is just, your stocking rate, if and that's not figured into any of this data. So if you're figuring that you're definitely going to get out in July, you might stock differently. As Mary said, you get that early growth in the spring, nutritious grass, and so on. If you're not going to extend into September, so you're going to go this slow growth route and definitely end in July, there could be some optimization there that you do in terms of just how many calves you put out on grass. And that's not taken into consideration here.